I think Albo was a big winner. You got to buy a $4.3 million house, negatively gear that, and then change the rules for everyone else.
Can you rule out any changes to negative gearing and capital gains tax?
Yes. How hard is it for the 50th time?
Mine is still intact, and I do intend to claim all the negative gearing I can on the Capital Combiner property.
You ruled out changes to negative gearing and capital gains tax for what you said was the 50th time. Does that mean that you lied 50 times?
Did they pass the pub test? No.
No, they passed the grub test. I mean, this was only last year. Albanese came out and said, my bond is my word. Quadruple backflip, boom, here we are. You can't trust the government, largely can't trust big business and can't trust big super.
CGT is going to go from the 50% discount down to an indexation method. This is going to have a real impact on your after-tax return on property. The gains taxed at a more realistic rate to what you've made a profit on, not just half of what your profit was. Negative gearing abolished, except for new builds. One thing the media has missed here, it's abolished in the current form where you get the immediate deduction. You will still get the negative gearing benefits when you sell the property because those losses will come off your profits. Strategy is more important now than ever. Negative gearing's never been a big thing in superannuation. The tax rate is so low, so the changes don't really impact us there. This now makes investing in the superannuation environment really even more attractive. We have a tax rate that is capped at 15%. So we've been investing in property now in superannuation for 5 or 6 years, and our clients are doing exceptionally well out of it. And the big win came last night when there's no changes to the CGT implications for a self-managed super fund and no changes to the negative gearing within a self-managed super fund. We're not going to have to change our strategy or deviate from where we're at the moment, but there's also some real opportunities that will come out of this in the future.
Short term, there's probably going to be some better buying opportunities, which will be favourable. I think one of the key battles we've fought over the past, particularly 2 years, has been the lack of supply, which has meant there's been a lot of competition. You know, when we're submitting offers and trying to win deals for clients, we've had to walk away from a lot. And obviously, we're looking at a property based on, yield and how much we pay and how the cash flow stacks up. And when you've got people that are coming in and paying, way overs, get to a point where financially it doesn't make sense anymore. So I think some of the changes will probably help buying environment, which is going to be, I think, a net positive for us. The superannuation environment hasn't been touched at all. So with the changes on the other side, looking at obviously negative gearing and CGT changes, I think it's really just reiterated, if you want to get ahead, other than the owner-occupied property, superannuation, SMSF, property and SMSF is the ultimate strategy.
I think rents are going to go up. We're going to see supply potentially fall. So for our clients that already got property, I think when we're actually renewing leases, we'll be seeing rents increase probably quicker than CPI.
With inflation at 5%, we'll see another rate rise. So if we've got rents increasing, I think that'll probably start to help the cash flow a bit. It's something that'll be necessary.
The biggest winner is superannuation, whether it's self-managed or any form of superannuation where the government have really left that untouched, but they've wanted to touch every other structure. Personal name, trusts have all been touched last night in terms of the tax implications. So it gives us a bit more certainty where we're headed. It hits home that using your super to invest in property is going to be one of the most tax effective things over the next few years. We've got a capital gains tax rate of effectively 10% after the discount because we are still getting a CGT discount in superannuation. This is going to compare to a capital gains tax rate in your personal name that could be up to 47% or 30% in a trust or company. So it's going to be really beneficial to keep superannuation going. Like your income's only at 15%, still far better than your personal name. And if we're getting close to retirement, we're getting close to that zero tax environment. So
there's probably going to be some unintended consequences from the budget the government probably didn't think about as we would have expected. On balance, next 12 months, probably going to be some good buying opportunities. Everything that did come out really just reiterates that, if you want to get ahead at the moment and you want to use, as many of the leg ups that government give you, I think, super is head and shoulders, so far above everything else. If people have been umming and ahhing, or they've been thinking about, what is our wealth strategy, how do we get ahead, how do we sort of decouple ourselves from, reliance on the government or the pension system, now is the opportune moment, take advantage, of a system that still works, that hasn't been touched. As with any investment, time's a secret ingredient. Let that compound growth do all the heavy lifting for you.
My one take from this is your strategy is really important. Making sure that they're correct correct and actually align to the changes that have come in or proposed to come in as of last night. So look at that, review that, and make sure you're on the right track. And if you're not, consider your options and look at the rules that are now in play that we've got to look at.
A bit of a wake-up event for a few people to actually have a look at where they are now based on that trajectory. Is that going to get them to a comfortable retirement or where they need to be? And I think if people haven't done some even, back of a napkin math on that, it's probably a good time to start having a look at that and just evaluate, what, if they need to make, and obviously with more time, those changes can be more subtle. But when you leave it and it's too late, you're really looking for drastic impact, which is not always realistic, in a short period of time. So.